So let's jump right in. So there's a couple of videos that you did recently, which I loved. The first one I thought was very interesting. You said Ben Bernanke won the Nobel Prize, and he's the one who created the inflation, the moves he made from the 2008 crisis.
Right.
And you essentially said that the stock market has been on life support since that time. Can you talk a little bit about that?
Talking about Ben Bernanke, everything that I have done, everything was based on a speech that Ben Bernanke gave in 2002 called Deflation, Making Sure It Doesn't Happen Here. And in that speech, he talked about what a central bank can do once they reach the zero bound, when they've taken interest rates down to zero. And if they go too far negative, then people will just hoard cash. They'll take cash out and take it home. And Japan had been suffering from this, and he was trying to say what the U.S. can do to prevent a deflation that was similar to Japan. And in it, he outlined things like, he called it expanding the menu of assets that the Federal Reserve can buy, which means mortgage-backed securities, for instance, which he did for the first time in the crisis of '08. And several other things. The QE, that was all outlined in 2002. And so when I wrote my first book, it was all based on sort of knowing what I could sort of see the future a little bit. The future was all in that speech.
Yeah.
And there are a couple of things that he did not do, but I feel that those things have yet to come true, that they're going to unfold in this next crisis.
So obviously it's very different. And, when in the mid 2000s, it looked to me like the QE kind of went to the banks, but now in the most recent one, it went to the people directly.
Yeah.
So can we talk about the difference that you see? Because one went straight to the people, and then, of course, that really created inflation. The other one went kind of to and from the banks, right?
Well, they both created inflation. It's just that there's something called the Catalan effect, and the inflation that we saw from 2008 to the end of 2019 was inflation of asset prices only. It went into the stock market because they're buying mortgage-backed securities. That kept interest rates low. It went into real estate. And so those things inflated, and that's basically a bubble. If you've got an economy with all of the different sectors of the economy balanced, and then you pump currency into just a couple of sectors of the economy, they go out of balance with the rest of it. The free market will always try to balance everything. When it does balance them, when it's an artificial bubble that's been created by something like a central bank, manipulating interest rates, creating currency, doing everything that they've done, when the market does overwhelm the manipulation, it comes as a crisis. And then the Federal Reserve and all the world's central banks will start screaming, the free market isn't working. We've got to do something.
More control. So
it's their fault, though. It's 100% their fault.
So how is this time different than '08?
You're seeing retail inflation now simply because we sent out checks directly to, first, they create the supply chain issues by just shutting down the world economy.
Yep.
And then they send checks directly to businesses and individuals. The checkable deposits, I believe, are up something like 28 times what they were at their minimum back in 2008. So it's huge. And that is causing the inflation. If they feel better and they feel like they've got a little bit saved up, that currency comes out and it buys groceries and gasoline. The wealthiest 1%, their deposits are up 111 times from the bottom in 2008. All of these things, the excess currency that's in checking accounts will come out and sort of work its way around the economy. And it will continue to, even if Jerome Powell tries to get ahead of inflation by raising rates above the interest rates above the inflation rate, there's still all of this trapped excess currency just sitting there in the checking accounts, and it is like $7 trillion or something like that right now. This will end up somewhere. It's not just going to stay in their checking accounts. It's going to come out, and if they are seeing their inflation at 8, 9, 10%, this erosion of their purchasing power, they're definitely going to get that out of their checking accounts. If regular assets, the stock market, and right now with them raising interest rates, real estate, it has been tanking, and it will, which is going to be good for you.
Yeah, I know. You make money when you buy, by the way.
Exactly.
Yeah. So that's what we're talking about.
And so it's going to seek safe haven assets, I think, this $1.33 trillion.
I noticed, I just got done traveling I was in Indonesia and Thailand 2 weeks ago. I was there for almost a month. And one of the things that everybody's upset about in the UK and, across Asia is the strong dollar. And
yeah.
I know you did a video on this. It's causing pain around the world. I was hearing about it from people. They said their strong dollar is killing us. Can you explain why that is?
It can benefit them, though, when it comes to their exports.
Correct.
But a lot of the things that they have to buy, like oil, is priced in dollars.
Right.
So if their currency has to be converted to dollars to buy those things, then it is killing them.
Yeah.
You're seeing the price of oil not only go up as much as it did here, but then you take the exchange rate and put it on top of that, and yeah, it is just murder. And there's going to be 50 years from now or 100 years from now, when historians look back at this period with all these floating exchange rates, this monetary system that we're on was an accident. It's like what was left over when Bretton Woods collapsed.
Right.
It was they tried to do something called the Smithsonian Agreement. There was going to be a planned monetary system, and it fell apart in like 3 days. And this is an accident. The floating exchange rate, U.S. dollar reserve currency system, and historians are going to look back at this period of time and go, what were they thinking?
Let's talk a little bit about inflation. We've had 5 now, going on 6 rate increases since March. Inflation's almost the same, at least in the United States.
Right.
It's higher in like the UK, not by a lot, but a little bit higher. And so we've got this. It feels like we've got global inflation, and these federal funds rate hikes don't seem to be doing anything.
All over the world, central banks went nuts during both the global financial crisis of 2008 and the pandemic. Now, the pandemic sort of kicked off the retail inflation, but it was inevitable anyway, because people that get rich in the stock market eventually take some of it out and they spend it on real things.
Yep.
And so you would have seen some of the excess currency that was created that caused those bubbles come out of those bubbles and create inflation elsewhere.
We've got high interest rates, which is caving the housing market right now. As you know, we're already seeing big corrections just in the last 4 or 5 months. And it doesn't appear that inflation is going to come down anytime soon, and people are getting squeezed.
Well, inflation will come down as soon as Jerome Powell breaks the economy. When the next big crisis happens, velocity will stop. The number of transactions that a dollar is involved in a year, that, when people are feeling good and they take their friends out for dinner and stuff like that, dollars circulate. There's high velocity. When it's in a savings account, there's zero velocity of the currency that's in the savings accounts. And so when it stops, then prices do come down. They will fall.
If anybody wants to get on your newsletter and get a copy of your book, we can put that on there. What's the best way to reach them?
Can join our mailing list at goldsilver.com.